Did you know that in October 19, 1987, stock market witnessed largest collapse in single day? And in that day, Dow Jones Industrial Average fell by 22% and wiped out more than 1 trillion in global wealth. But actually, what happened in this day, and are there any lessons that traders and investors today could learn? In this video, we will find out. Firstly, we will see the buildup which led to this crisis. Secondly, we will have possible explanations and reasons why it was so fast and severe. And let's see what was the aftermath. For that, I would show you examples from historical S&P 500 chart. So what happened? In this time, markets actually were very overvalued and many professionals waited for some sort of correction or larger crisis. There were instabilities in global commodity and forex markets. Laws and regulations prohibited aggressive mergers and acquisitions in early October, and there were possible signs that there were instabilities in Federal Reserve policy as well. But if you look at it, it was week of October 5th, markets were close to all-time high. But in the next 2 weeks, markets had some downwards move and then they collapsed. I will show you here in daily charts. Actually, right up until October 13th, which was previous week, markets were close to all-time high. It were 335 at their peak, and in October 13, which is 5 days prior, it were at 2,315. Despite my previous warnings, markets didn't react, but actually it was Thursday and Friday when they started to make some downwards move. Also, there were no major defaults of financial institutions as it was in 2008. There were no wars or political instabilities or whatnot. Actually, markets simply opened sharply lower and continued to fall. Reasons were many, but the fact of the matter is it was astonishing, because here you will see it went from 282 right up until 226 in just one day. So what happened? Stock prices were normally higher because there were no liquidity, many were not traded at all, and there were huge gaps in price executions. But futures markets for stock indices continued to trade, and that meant there were huge gaps and huge price inefficiencies, and that caused chain effect and markets panicked even more. And actually, this panic itself nearly caused troubles in financial system, because if there is simply selling pressure and everyone starts to sell because prices are getting lower, there are instabilities in brokers and specialists and other people who are actually responsible for clearing. So that means people start to sell. It puts pressure on brokers because brokers have to execute those orders. But if there are too many sellers at too short time notice, they are not able to do that. So they have huge inefficiencies in their accounting and clearing. And that puts risk not only on traders and investors who are not able to execute their trades, not only on brokers who have responsibility to do that, but to the banks who are holding brokers' accounts, and ultimately to central bank. So what happened? Federal Reserve made official statement that they will help with liquidity. Their idea was that if they are going to provide liquidity to the banks, giving them money so that they could pay their brokers and brokers could pay their customers, there wouldn't be any huge bank runs, and that wouldn't cause some catastrophic events to financial system. To a large extent it worked, because they provided liquidity to the banks and major players, which thus provided liquidity to brokers. So actually this crisis ended in that one day, and that one huge price drop actually was the lowest point, because even though the markets were not able to rebound the next month and went approximately to those levels slowly without that dramatic effect, this was the lowest point that was reached in Monday and early Tuesday in October 19 and 20. What happened after that? Markets rebounded 1.5 years later in summer 1989 and actually went higher and never looked back, because 1990s were even better bull market than it was in 1980s. This crisis, as opposed to 2008 when Lehman Brothers collapsed, or 1929, it actually didn't have huge effect to overall economies. It was simply dramatic market fell, which happened in just a couple of days. And actually, interesting fact is that the reaction was similar across the world. So whether this was in Asia or in Europe or America, markets witnessed comparable falls and the responses were somewhat similar. The question is why it happens. Funny thing is that up until this day there is no clear explanations why. It was simply combination of events because people saw that there is selling pressure. So what they did, they anticipated that themselves, and either they were trying to sell to make money or liquidate their positions. For instance, many brokers held client accounts. Many mutual funds had clients' accounts who all panicked. So that means mutual funds and brokers who had responsibility for thousands and thousands of clients were forced to liquidate at split second. And that means they had huge amount of orders which they had to execute right away. And that simply created, I would say, tsunami of sell orders, which simply happened to be at same moment, and this moment itself caused panic effect because many other traders saw that and they thought there were some huge problems and it spun out of control, and fear of something bad created actual fact that something bad might happen. This is a self-fulfilling prophecy in financial markets. When we are fearing of something, we are anticipating that bad thing might happen, and actually it happened just because we are in fear of that. This is a very good example of that. But what we can actually learn about this in present day, we can learn that if there is huge selling pressure and everyone wants to sell because simply we have to sell, it could create panic effect. And at that time, in late 80s, many trading and investing strategies were automatic. Many buy and sell orders were initiated automatically. So it was so fast because this was not time anymore when people were buying and selling on the phone, at least in the institutional level. Many orders were created automatically, and yes, they had lower execution speed as it were today, but still they were initiated automatically, and since they were huge crowded trades, it helped to fuel this fall because it simply were not able to fill. For instance, if I want to sell something at 100 and I see that prices are at 90 and I still are not able to execute, I will be panicking and probably I will sell all of my securities and want to get out of markets. And if we multiply it by 100,000 or million other traders and investors, you could imagine the difference. And in today's world, everything happens in split of second. Imagine huge pension or mutual funds where we have tens of millions of investors who wanted to liquidate their positions. What will happen if they start to do that at one moment? Many ETFs, many funds, many brokers, these players are not able to execute all these trades like that. And that is the problem. And I would say this is the reason why crisis of 1987 stands relevant for to this day, because it might happen any time when there might be some risks in financial system or some unexpected moves and people start to panic. When people start to panic, they will all simultaneously close their positions, and the largest players in markets won't be able to execute that. And how that would spill to the rest of the financial system, how that would look in practice, who knows? If we look at bond markets or largest stock markets, they are interrelated to central banks, and maybe central banks would provide liquidity and price execution would be more or less smooth. But what will happen with crypto exchanges which are unregulated? No one will give them money for liquidity. So if something bad happens there, it could give cascade effect in crypto markets, which will have more severe moves than in stocks or bonds or any other regulated market. And actually, we saw the similar situation, what happened there in late 2022 when exchange FTX collapsed. So I would say this is more warning to not bond markets or any other regulated markets, but to crypto markets. No one knows why it was so severe, but we know if people are panicking, they're panicking together and making huge irrational moves, which could have spillover effect across board. In that time, this risk was limited and nothing happened thereafter. But what will happen in future? No one knows. So my point is learn history, learn different events, different, I would say, financial markets and why something happened, why it happened, because otherwise, if we don't learn about these lessons, we might make the same mistakes in the future.